When you take a dividend from a company, what should you consider? Well, the expression distributable reserves is key. That means distributable profits available upon which the dividend can be declared. Now, when you take a dividend, you need distributable profits and you need relevant accounts. Relevant accounts are typically going to be, for most SMEs, the most recent filed statutory accounts. If you produce monthly management accounts, quarterly accounts, etc., provided they, broadly speaking, comply with the accounting standards, then ultimately you can use those. If you are using the most recent filed statutory accounts, then that ultimately is where the legislation lies in terms of relevant accounts. But you also need to consider not simply whether the dividend is lawful in accordance with the Companies Act, but whether in accordance with directors' duties there is nothing that could call into question the so-called creditor duty, particularly if the company is either balance sheet or cash flow insolvent. Then it is possible that the dividend could potentially be unlawful or a breach of duty if the company cannot in effect afford to pay it. And because a dividend is in effect a transaction under value, in other words, the company doesn't get anything in exchange for the dividend, it's simply a distribution of capital to the shareholders, you do need to consider the financial position of the company before you actually declare and pay a dividend. Fundamental. Questions, queries, concerns, give us a shout. We know insolvency inside out.